PantheonAI presents Markets Rally on Strong Jobs Report, Apple Buyback, Trump Rate Push, FTSE Surge. Welcome everyone to the PAI Morning Briefing.
And good morning. It is May 2nd, 2025. I'm here with my co-host, ready to dive into today's market landscape.
That's right. We've got a lot to cover. We'll start with a quick overview, then sift through some major trends, look at about a dozen key stories, and finally wrap up with sector performance, global implications, and some expert insights.
Sounds like a packed agenda. Grab your coffee, sit back, and let's get right into it.
Absolutely. Let's kick things off with the market data. The S&P 500 is trading right around 5,674.84.
Okay, and that's up by roughly 0.5%?
Yep, about 0.5%. Over in the blue chips, the Dow Jones is standing at around 41,203.07.
An increase there too, right? Like 0.6%?
Exactly, marking an increase of about 0.6%. And the Nasdaq, not far behind in momentum, is up at roughly 17,941.21, having gained slightly by 0.4%.
All right, so we're seeing green across the board for the major indices. How about the smaller cap guys, like the Russell 2000?
The Russell 2000 is holding steady at about 2006, with an uptick of nearly 0.4%.
Okay, so a pretty positive picture in traditional markets today. What about the crypto world?
The crypto corner. Bitcoin is sitting strong at approximately 97,208.88.
Wow, still holding that level. And that's up by
nearly 0.7%. And Ethereum is trading around 1,843.23, adding a modest 0.2%.
Interesting. So while traditional markets are showing balanced optimism, crypto assets are still showing resilience, even with a cautious global backdrop. That's quite a contrast.
It really is. Now, let's step back and look at the broader trends at play.
Yeah, what's really fueling this positive pulse we're seeing?
It seems to be fueled by some strong underlying economic data. Notably, that better-than-expected jobs report for April.
The jobs report, right. That does create a sense of cautious optimism, doesn't it?
Totally. Many see this as a clear indication that the U.S. labor market remains robust. And that, of course, supports consumer spending and overall market stability.
But it's not all sunshine and rainbows, is it? There are still those cautionary notes.
Definitely, especially with those mixed signals we're getting from central banks and political leadership.
Speaking of political leadership and signals, there's a trend that's been echoing everywhere. Jim Cramer's top 10 things to watch.
Oh yeah, Cramer's playbook. According to him, stock futures are hinting at a positive open today, largely bolstered by that strong jobs data we just talked about.
What's intriguing to me is how this sentiment is really permeating every corner of the market, from big tech down to those more vulnerable mid-cap sectors.
Right? And Cramer's list, which you see repeated across channels, really underscores the need for both short-term traders and long-term investors to stay agile and adaptable.
Absolutely. And on a lighter note, if the markets were a group project, it seems like everyone's finally pulling their weight today, even if sometimes it feels like it's just a paper lift.
Ha, good analogy. Now, for another headline making rounds, and one that's echoing in the corridors of political power.
Oh, I know where you're going with this. Former President Donald Trump calling on the Fed to lower interest rates again.
Exactly. He argues that following that strong April jobs report, the economic landscape could benefit from more accommodative monetary policy.
It's not often you see political figures stepping so directly into the monetary policy arena, is it? His remarks certainly stirred the pot.
They really did. And while central banks are in their own thoughtful deliberations and tend to maintain a cautious stance, these comments do remind us of that ever-present interplay between politics and market movements.
It raises a big question, doesn't it? How much should political rhetoric influence our view on monetary policy when economic fundamentals continue to shine?
A very valid question. Shifting gears slightly, let's look across the Atlantic. London's FTSE 100 is actually on track for record-breaking gains.
Record-breaking? Wow. Market watchers must be buzzing.
They are. The index is embarking on what appears to be its longest series of consecutive daily increases. The British financial sector is really enjoying an invigorated period right now.
And that's buoyed by strong corporate earnings and just an overarching positive sentiment, right?
Exactly. Investors are starting to wonder if these gains might be a precursor to a sustained rally across European markets.
Maybe it's that classic case of British stiff upper lip meeting market dynamism. Haha.
Could be. Now, let's shift our focus a bit to corporate moves. Apple's $100 billion buyback has been a huge topic of discussion.
Oh yeah, that's a massive number. Though it didn't quite beat their previous record, did it?
No, not quite, but it still positions Apple as an enduring leader in share repurchases. For many investors, this really signals robust confidence in the company's future prospects.
Even as they navigate competitive pressures and supply chain dynamics, which we know they've been dealing with.
Right. The implication here is that even market giants sometimes need to recalibrate expectations. And in that recalibration, there's room for both caution and opportunity.
That's a good point. Let's take a moment to break these stories down further, because they really offer a snapshot into the interplay of broader market forces.
Absolutely. Starting with Jim Cramer's top 10 list again, it's worth noting that his watch list isn't just about bullish signals.
No, it's more nuanced than that, isn't it?
It is. It encourages investors to look at volatility, liquidity, and even emerging tech sectors that might buckle under economic headwinds before reversing course.
Okay, so it's about being prepared for different scenarios.
Precisely. His emphasis on futures reflecting a positive open indicates that traders are sizing up a market that's progressively factoring in solid job numbers while keeping an eye on inflationary pressures and rising input costs.
Right. So in many ways, his list is like a checklist for those wondering if the robust labor market can really continue to sustain economic growth in a possibly tightening monetary regime.
Good way to put it. Next, Donald Trump's call for the Federal Reserve to lower interest rates really underscores a political desire to stimulate further economic expansion by making borrowing cheaper.
And his call comes right after that jobs report that gave a nod to economic resilience.
Exactly. However, the Federal Reserve operates on a different rhythm. They're weighing inflation concerns and global economic uncertainties.
So it stirs up that lively debate. Could lowering rates, even temporarily, spark unwarranted inflationary pressures or catalyze a burst of asset bubbles?
Exactly. And honestly, in a twist that sometimes makes you chuckle, while politicians are calling for lower rates, many economists are knee-deep in data models, predicting everything from inflation spirals to unintended booms.
Haha, always a bit of disconnect there. Across the pond, that record-breaking rally in London's FTSE 100 offers another intriguing angle.
It does. The British market is experiencing its own renaissance, with long-standing institutions showing unexpected vigor.
The narrative there seems clear, right? Despite facing uncertainties like Brexit legacies and global trade turbulences, the resilience of London's financial sector is proving to be a cornerstone.
Definitely. Market watchers aren't just counting pips. They're watching a potential trend where Europe's key indices might actually set the tone for broader global risk appetite in the coming weeks.
Fascinating. And then there's Apple. It's almost poetic that a company that huge and globally integrated continues to walk its talk with a buyback program that underscores shareholder returns.
It really is. While some critics might be disappointed the program didn't surpass historical benchmarks, there's a perspective here. Apple remains a steadfast force.
Their ability to navigate market uncertainties while distributing capital back to shareholders. That's a testament to their financial discipline and strategic foresight.
Totally. And honestly, isn't it kind of like that friend who always shows up when you need to cover the tab, even if they don't break all the records?
Haha, yeah, reliable friend in the market. Taking a deeper dive into the trends, the stock market's positive mood today isn't just a reaction to isolated data points.
No, it feels like part of a broader narrative of recovery and cautious optimism.
Exactly. The labor market's recent strength is providing that consistent backdrop, fostering consumer confidence.
But at the same time, concerns about inflation and geopolitical tensions add that layer of complexity.
It's a bit like enjoying a warm cup of tea on a brisk morning, isn't it? Comforting, but with that subtle reminder that winter might still be lurking around the corner.
That's a perfect analogy. In the world of cryptocurrencies, Bitcoin and Ethereum's modest gains, they suggest a market finding its balance amidst the sea of variables.
There's an interesting narrative there. While traditional markets are buoyed by domestic indicators, crypto investors seem to be taking solace in the decentralization ideal and the promise of blockchain technology.
Yeah, but let's be honest. Crypto markets can be as unpredictable as that one friend who insists on investing in every hot new meme coin.
Haha, true. It makes you wonder, are these assets stepping into a new era of maturity, or do they still dance to the erratic tune of sentiment-driven volatility?
Good question. Another aspect influencing market behavior is that interplay between centralized and decentralized financial forces.
Right. As we see strong fundamentals in conventional markets, there's an underlying curiosity about whether alternative assets like cryptocurrencies might eventually contribute to portfolio diversification in a weighty way.
Investors are increasingly questioning if the digital asset class might serve as a strategic hedge against traditional market risks. It's an evolving narrative that's definitely worth watching closely.
Beyond these headline stories, let's consider a few other key headlines that have been circulating. Even though they repeat some themes we've discussed, it's good to frame them in a richer context.
Like another perspective on Donald Trump's remarks, exploring the tension between political narratives and economic policy.
Exactly. While his call for lower rates aligns with the desire for aggressive stimulus, the broader implications hint at potential regulatory hurdles and a recalibration of fiscal policy, especially with global uncertainties.
And market chatter about Jim Cramer's watchlist has sparked debates across social media and forums.
Oh yeah, some traders love the detailed rundown, others prefer pure data analysis, free from celebrity influence.
That dichotomy is interesting. It reminds us that in the market universe, there's room for both qualitative insights and rigorous quantitative research.
It's that classic blend of spirited conversation and hard-nosed financial analysis, keeping markets as lively as a debate between two rival chefs arguing the merits of a secret sauce.
Haha, perfect. The situation in Europe, with London's FTSE 100 nearing records, is drawing attention not just for the numbers, but because it signifies broader confidence in European corporate performance.
With many European companies showing high efficiency and adaptability, this trend might reflect a shift in investor sentiment back towards established financial strongholds, away from perceived riskier emerging markets.
It makes you wonder, doesn't it? Could we be witnessing a renaissance for European equities, one that might challenge the long-standing predominance of U.S. markets?
Could be. And let's not forget sector-specific insights. On the tech front, apart from Apple's announcement, there's still an undercurrent of optimism.
Definitely. Industry giants are reporting healthy earnings, and investors are focusing on innovation, AI, and future growth potential.
But tech stocks remain sensitive to regulatory changes and disruptions. So while the outlook is upward, caution is never far behind.
It's a bit like riding a roller coaster, right? You're in it for the thrill, but you never quite settle into complacency.
Good point. In the energy sector, headlines might be quieter than tech or finance, but there's that ongoing debate about renewables versus traditional oil and gas.
Global energy prices are still seeing fluctuations, influenced by geopolitical tensions and evolving environmental policies.
That dynamic creates both opportunities and risks. Whether you're a believer in the green revolution or a veteran oil strategist, the energy sector is one of those key plays requiring both long-term vision and agile response.
Absolutely, and the financial sector isn't standing in the wings either. Banks are showing resilience amid rising interest rates and shifting regulations.
Their performance often mirrors broader economic confidence, but they're also a bellwether for consumer spending and business activity.
Some are even drawing parallels between the financial sector's current positioning and opportunities that might arise as economic growth picks up steam, despite occasional whispers of regulatory tightening.
For investors, it's a sector that demands attention, a mix of promise and prudence that can sometimes feel as unpredictable as debating whether to order extra cheese or stick with the classic margarita.
Haha, I feel that. As we shift our lens to global market implications, it's clear that trends in the U.S., Europe, even emerging economies are all interconnected.
Definitely. The strength of U.S. jobs data sends ripples across the Atlantic, often influencing monetary policy overseas.
And Europe's impressive performance, like the FTSE 100, could bolster global investor confidence and contribute to a broader risk-on sentiment.
Even the upticks in crypto values signal that while traditional markets follow fundamental data and political announcements, there's still a global appetite for risk and innovation.
So what does all this mean for our listeners, the investors and traders out there?
It means a nuanced approach is more critical than ever. Keeping up with the multiple narratives, from solid economic data, cautious political statements, bullish watch lists, and the pulse of crypto, helps ensure your portfolio is well positioned.
To weather storms while capitalizing on opportunities. It's about balancing risk with opportunity and understanding that every headline carries both data and human sentiment.
Speaking of sentiment, let me throw out a thought-provoking question. With such diverse market signals, how do you decide which data points carry the most weight for * your investment strategy?
Good question. Is it the solid numbers from the S&P 500, or the buzz generated by political figures and celebrity analysts like Jim Cramer?
And if cryptocurrencies continue to mature while staying volatile, will future portfolios look significantly different from what we see today?
Lots to think about. As the day unfolds, we're keeping our eyes on several key themes. In expert circles, there's a growing consensus that while short-term fluctuations are inevitable, the long-term trends remain robust.
Economic fundamentals, particularly in tech, energy, and financial sectors, seem solid, but the market is also adapting to rapid technological change and shifting policy landscapes.
It's a dynamic, sometimes perplexing ecosystem that demands both informed analysis and a fair bit of humor to navigate.
Speaking of humor, didn't an analyst joke that predicting the market today is a bit like trying to predict the weather in April?
Oh yeah, sunny one moment, caught in a downpour the next. And while we can't control the chance of rain, we can carry an umbrella and adjust our plans.
And that, in a nutshell, is what being a savvy investor is all about. Let's do a more detailed sector analysis now.
Sounds good. Starting with technology again. Beyond Apple's buyback, the sector at large is seeing fascinating shifts with companies channeling investments into AI and cloud computing.
These tech frontiers are becoming not just revenue drivers, but blueprints for future economic transformation.
Right. Investors have noted that even if a company's quarterly numbers miss lofty expectations, the underlying long-term innovations provide an irresistible edge.
The tech sector, with its rapid pace, almost feels like a never-ending startup story operating on a scale that would leave even the most energetic entrepreneur breathless.
Totally. Then turning to energy, a sector that sometimes feels like a Shakespearean drama with its highs and lows.
Yeah. Traditional energy companies are navigating a transition, balancing fossil fuel revenues with significant investments in renewables.
What's compelling is that while national policies push for greener alternatives, global demand for energy remains unwavering.
So the narrative isn't an abrupt shift, but a gradual transformation. Investors might be rewarded over time as companies adeptly manage this transition.
It reminds me of that old adage, nothing lasts forever, except, perhaps, the need for energy.
Good one. The financial sector, meanwhile, continues to bask in the glow of economic resilience.
With interest rates influencing lending and borrowing, banks are treading a delicate line between cautious practices and tapping into growth opportunities.
This balancing act is tricky, requiring prudence and innovation. Financial institutions are kind of like the unsung heroes, quietly enabling every other sector to flourish.
True. Yet, as newer financial technologies and regulatory shifts enter the fray, these institutions also have to adapt at lightning speed.
On a global scale, the interplay of these sectors creates intriguing market implications. European markets, signaled by London's FTSE 100, are hinting at a return to form for traditional equities.
Perhaps priming themselves as attractive alternatives to U.S. markets if geopolitical uncertainties come to the fore.
Meanwhile, in Asia, economic recovery efforts are balancing domestic reform and export performance, feeding into global supply chains.
One might say that if the market were a grand orchestra, these regions and sectors are playing their parts in a symphony of growth and cautious optimism.
That's a great way to visualize it. Now, let's look ahead with some expert insights and predictions.
Many prominent analysts suggest the underlying tone remains optimistic, supported by strong labor stats and solid corporate earnings.
But there's that undercurrent of caution regarding potential shifts in monetary policy and unpredictable international trade dynamics.
Some experts believe if current trends continue, we could see sustained, maybe not vigorous, growth in both traditional equities and alternative assets like cryptocurrencies.
Others, though, recommend a diversified approach, ensuring portfolios are resilient enough for unexpected reversals.
And yes, while it might sound like balancing acts akin to juggling flaming torches while riding a unicycle, that's often the reality in today's multifaceted market.
Before we wrap up, I've got a few questions for you listeners to ponder. How much weight do you assign to political commentary, versus hard economic data when setting your strategy.
What sectors do you think will outshine in a world where both technology and sustainability drive growth?
And finally, in a time when innovation is key, how do you balance the lure of high-growth tech stocks with the reliable returns of traditional sectors like finance and energy?
Lots to consider. As we reach our conclusion, let's just quickly recap the key takeaways from today's briefing.
We saw traditional market indices showing modest gains, reflecting cautious optimism fueled by that stronger-than-expected jobs report.
Cryptocurrencies, while showing slight upticks, remain in a state of measured resilience.
Headlines from Jim Cramer and Donald Trump added layers of complexity and debate, while London's FTSE 100 and Apple's Buyback show global markets are not just recovering but evolving dynamically.
In our sector analysis, tech, energy, and finance each told a story of innovation, transition, and adaptation. This mosaic offers both opportunities and cautionary tales.
The global implications are clear. Markets are interconnected, and shifts in one region or sector ripple across the world. The challenge for investors is navigating this with an analytical mind and readiness to adapt.
We want to give a big shout out to PantheonAI, our information copilot, for keeping us updated and ready for this ever-changing financial landscape.
Our discussions today remind us that while numbers and headlines are the backbone of analysis, it's the human element, our insights, humor, and curiosity that truly brings the narrative to life.
Before I sign off, remember that learning shouldn't feel like a full-time job.
In a world of rapidly evolving markets, every day offers fresh insights. Whether you're deciphering a jobs report or laughing at a market quip, the journey of understanding and investing is both challenging and rewarding.
Thank you for tuning in to this edition of the PAI Morning Briefing. We hope our conversation provided valuable insights, intriguing questions, and maybe even a smile or two.
Stay curious, keep learning, and feel free to reach out with your questions to our AI copilot. We're here to help you navigate the fascinating world of finance.
Join us again tomorrow for another deep dive into the markets. We'll explore emerging trends, share expert analysis, and, of course, have a few laughs.
Until then, keep your analytical minds sharp, your portfolios diversified, and remember, learning shouldn't feel like a full-time job. PantheonAI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.